The macro setup for gold right now is unlike anything we have seen in 40 years. And I do not mean that as hype. I mean it as a precise, data-driven statement that I want to prove to you in the next 10 minutes using the actual numbers sitting on the table right now. Gold is at $4,352.30 an ounce. The federal funds rate is at 3.63%. US CPI is sitting at an index reading of 332.568. Real GDP growth is at 1.5%. Those four numbers together tell a story that most mainstream commentary is completely missing, and by the end of this video you will understand exactly why. Let me start with the real federal funds rate, because this is where most people get confused and it is the single most important driver of gold's structural move right now. The nominal Fed funds rate is 3.63%, but the CPI index at 332.568 translates to a year-over-year inflation rate that is still running meaningfully above what the Fed is comfortable calling victory. When you subtract inflation from the nominal rate, you get the real rate, the actual cost of holding cash. Right now that real rate is barely positive, clinging to existence. Here is the thing almost nobody talks about: every time in modern history that the real federal funds rate has been below 1%, gold has outperformed virtually every major asset class over the following 18 months. We are living in exactly that window right now, and gold knows it. Gold is not at $4,352 because of a short-term panic. It is at $4,352 because the structural monetary conditions that produced the 1970s gold bull market, the 2000s gold bull market, and the post-2008 gold rally are all present simultaneously for the first time since at least 1980. That is the 40-year claim I opened with, and here is the evidence. Let's talk about the yield curve, because it is doing something extraordinary right now. For much of the past 2 years, the US yield curve was deeply inverted, meaning short-term rates were higher than long-term rates. Inversion is the bond market's recession warning signal. It has preceded every US recession since 1955 without a single miss. Now the curve is in the process of re-steepening, uninverting, and history shows that the re-steepening phase is actually more dangerous for the economy than the inversion itself. Why? Because re-steepening means the bond market is starting to price in either a Fed rate-cutting cycle, recession risk, or both. And in that environment, gold has historically surged. In the re-steepening phase after the 2000 inversion, gold nearly doubled within 3 years. After 2000 SIXS re-steepening, gold went from roughly $600 to over $1,900. We are in a re-steepening right now. Now here is a macro fact that I almost never hear discussed on mainstream finance channels. The US real GDP growth rate is 1.5%. That sounds almost okay until you understand what it means in context. The Congressional Budget Office estimates that the US economy needs roughly 1.8% to 2% real growth just to keep the debt to GDP ratio stable. At 1.5%, we are growing below that threshold. The debt is compounding faster than the economy, and when that happens over a sustained period, the historical pattern is clear. Governments and central banks eventually tolerate higher inflation rather than enforce austerity, because the political cost of austerity is too high. Tolerating inflation is, in simple terms, the slow-motion default on the debt. And gold is the asset that has survived every slow-motion default in history, going back to Rome debasing its silver coins in 260 AD. Now let me bring in the liquidity picture, because this is the hidden mechanism that actually moves gold prices day to day. Liquidity is the total amount of money flowing through the financial system, and right now it is doing something most investors are completely misreading. The Fed has been running quantitative tightening, draining reserves from the banking system, since 2022. But here is the twist: the US Treasury has been simultaneously drawing down its Treasury General account, effectively injecting liquidity into the system even as the Fed tried to remove it. These two forces have been partially offsetting each other, keeping liquidity tighter than the 2020 to 2021 era but looser than many investors realize. Gold responds to net liquidity, and the net liquidity signal right now has been gently positive, which is part of why gold has been able to hold and extend gains even as the Fed maintained relatively restrictive rates. Now I want to address something a lot of you have been asking in the comments. Many of you asked whether gold hits $5,000 by end of 2026 or whether we see a pullback below $4,000 first. Here is why that question, as tempting as it is is actually the wrong frame. The macro signal is what tells you whether the structural bull case is intact, and right now that signal is pointing unmistakably in one direction. You have a real rate barely above zero. You have a re-steepening yield curve. You have GDP growth below debt stabilization threshold. You have global central banks that have been buying gold at a record pace, over 1,000 tons per year for 3 consecutive years. You have de-dollarisation pressure from BRICS nations explicitly seeking to reduce dollar reserve dependence. Every single one of those factors is a structural tailwind, not a short-term trade. And here is a fact that should genuinely stop you in your tracks. The ratio of outstanding paper gold contracts to physical gold available for delivery on the COMEX exchange has recently been estimated at over 100 to 1. That means for every 1 ounce of physical gold backing the paper market, there are over 100 claims on that ounce. This is not a conspiracy theory. It is a structural feature of how the futures market works. But it becomes acutely important when large players, particularly foreign central banks and sovereign funds, start demanding physical delivery instead of cash settlement. When that shift accelerates, the paper price and the physical price can disconnect violently, and that process appears to already be underway. Some of you also asked whether gold at $4,038 or $4,113 earlier this year was being underappreciated by mainstream investors. The answer, based on the macro mechanics I just laid out, is yes. The mainstream framing of gold as purely an inflation hedge is about 20 years out of date. Gold today is better understood as a sovereign risk hedge, a hedge against the institutional credibility of the entire dollar-based financial system. That is a much larger addressable market for the asset. And when institutions start repricing gold on that basis rather than just CPI, the numbers get very large very quickly. Let me connect the bond market picture one more time before we close. The 10-year Treasury yield is one of the most watched numbers in finance. When real yields on the 10-year fall, gold rises, almost mechanically, because gold's main competition as a store of value is the real return on safe government debt. If that real return is thin or negative, gold wins. Right now, with the Fed at 3.63% and inflation eating into that return, the real yield environment continues to favor gold over sitting in cash or short-duration treasuries. So what is the macro net signal? It is bullish. Not because of one factor, but because of the convergence of at least 6 simultaneous structural forces: real rates near zero, re-steepening yield curve, below threshold GDP growth, record central bank gold buying, paper-to-physical market stress, and active de-dollarization by sovereign actors. That convergence has not existed at this scale and simultaneity since the late 1970s. And in the late 1970s, gold went from under $200 to over $800 in roughly 4 years. If you are a macro-focused investor trying to understand where we actually are in this cycle, this channel is built for you. Subscribe and turn on notifications because every week we go deep on exactly these mechanics: real rates, liquidity flows, bond market signals, and what they mean for gold and hard assets. You will not get hype here. You will get the numbers and the framework to think for yourself. And speaking of thinking for yourself, I am not a financial advisor. I am obsessed with these macro mechanics and I share every insight I find, but nothing here is financial advice. Please do your own research, speak to a professional if you need to, and form your own view based on your own situation. That is the only way any of this actually means something for you.